Alright, so we had a bad end. Let me see. Make sure it's recording. Okay, so we had a bad end to the week last week. The main problem was international crises that had a macro effect across many different stock markets, most notably China, which then integrated a circuit breaker where they shrank market time. So here's the basic idea. On Wednesday, the market crashed because there's some conflict between Iran and Saudi Arabia. They cut ties, they kicked out their diplomats. This happened before the Chinese market opened, and at that time the market started to crash. Chinese authorities decided to put a quote-unquote circuit breaker on the stock market and close the markets so that people couldn't sell their stock. Now, this is where market time comes into play. Market time is different from time in mathematics or in physics. It's nonlinear. It's like a fractal. And you don't have to be a scientist to understand what that means in terms of the stock market, but if it's like a fractal, here's the main idea. If you take a stock chart of, let's say, a stock that you don't know of in the past hour, and in the past day, and in the past month, in the past year, in the past 10 years, and you look at them without the labels, so you don't know which one is from which time period, they'll all look pretty much the same. You won't be able to guess which is from which time period. That's because market time is like a fractal. If you shrink it down, just like a fractal, if you shrink it down, you see the same thing. It's stochastic, alright? So here's where this comes into play. The Chinese stock market had shrunken time during those 2 days of circuit breaker trading. So what you would originally have had in 8 hours was shrunk into 15 minutes. There's only 15 minutes of trading. Now, there's a psychology that comes into play here. If the government is shutting down the stock markets, the government's basically saying, hey, we know that the market's going to crash. If everybody is thinking the same thing, then whereas you would usually have a 8-hour period to look at the market, watch it for a bit, and then sell your stock, now you don't. Now you have 15 minutes to sell. So that's what happened. It caused panic. Everybody was like, we only have 15 minutes, we got to sell immediately at the market open, put in market sell orders, put in limit orders at the market open. Make sure that we can sell the stock within those 15 minutes. That's the most important thing for today. Whereas a normal day, you wouldn't be in such a rush. So what the government tried to do was stop that from happening, stop a panic from happening, but ironically, the result was a larger panic. So after a couple days, the Chinese government did the smart thing, and they stopped the circuit breaker, and people could trade at will. Now, at that time, the market bounced back because people suddenly were able to find stock at a lower than what they should be price. So instead of having, remember, the last 2 days were 15-minute trading days, so if you suddenly switch from a 15-minute trading day to an 8-hour trading day, now you're seeing market time expansion, so you're seeing what would happen in 30 days instead of 1 day. So in 1 day, we basically had a month worth of trading, and we saw the stock slowly go back upward. Now, that was good for the US market on Friday. It brought stocks back up a little bit, but then the stock market crashed again for about 1%. Not really a crash, but people sold off on Friday. And there's reasons for that. First of all, there is the volatility issue. There are lots of things happening in the stock market, especially last week. So people don't want to have that position open over the weekend when many things can also happen. Because volatility is going to be increased, and on Monday you're not really sure where your investment's going to be, so you may as well sell after the recent bump. So a lot of people got out on Friday, and that's more of a safety concern than anything. For you, for the average trader, for any trader, what this means is that, first of all, we got higher volatility. But if you are a trader that is not hedged, what this means is probably that you saw some losses last week. Now, to stop that from happening, you can hedge. And there are many different ways of hedging. I have a course on hedging you can follow. I have some free videos on YouTube on hedging that you can look at. You can also check out Bubba Trading, who has a hedging program, and I'll find that link and put it in the description below. But you've got to be hedged at all times. And even if that just means swing trading with the market, that's a way of hedging, because you're hedging against time instead of hedging against, for example, markets or indexes or sectors. Right? So you got to be hedged. That's the first thing. Now the second thing is, when the week comes up, we're going to see stocks at a relative low. Now it's not the bottom that we saw in October or September. We had a recent bottom. Now we're not there yet, but we might get there. And this would be a good time to buy some stock if you're bullish on the market. At the same time, it's also a good time to buy some put options or short some stock, because investors are scared and many people are expecting a market crash. Now that concern might not be valid, so you've got to do your own research. But overall, what you should be mainly concerned with in the upcoming weeks is that earnings are coming out. It's earnings season. There's a lot of stocks that are going to be releasing their earnings reports for quarter 4 2015 in this month. So what I would do if I were you is look up some stocks that you're interested in, see if their earnings are coming out, see what statistics. I usually use statistics, but you can just dig into other data, for example fundamentals of the stocks, and see whether you think the earnings report of quarter 4 2015 is going to be good or bad. If it's good, buy some call options. If it's bad, sell some put options or buy some put options. So that's what I would do. Now, a very pragmatic piece of advice is to look at Altria Group, which is of the ticker MO. So go type in MO. I'm going to leave an article below that I wrote on Seeking Alpha. It's an article on how MO's quarter 4 earnings reports are usually pretty poor, which makes January a good time to buy puts on MO, but it also makes February a good time to buy calls on MO or buy the stock outright. So right now, if you want a very practical example of how you can play stocks the following week, this upcoming week, you can buy puts on MO, or you can wait until February and buy calls on MO. And I'm going to run a back test on seeing whether this fourth quarter earnings reports can be played as a long-term strategy on this specific stock soon. So follow me on Seeking Alpha for that article, which will be coming out probably Monday. But as for now, look at the article on MO that I already have up there and consider buying puts on it for this week or buying it outright in February. It has outperformed the market for the past, since it was trading in 2008, so it's a pretty good stock to buy and hold. And if you think that we're at a relative low, it would be a good time to buy in February. But that's it for now. So make sure you're hedged, check out those hedging programs, and look into some stocks that you are interested in that will be releasing their quarter 4 earnings reports within the next couple weeks.